You're watching Expert Insights.
Hi, everybody. It's Alex Sasso. Today is August 8th, 2024. I'm the lead manager of the Income Growth Fund. A few different things we're going to talk about today. We're going to talk about the power of dividends. The second thing would be the importance of the payout ratio and why I pay attention to it. And then the third and final thing we'll talk about is expected interest rate cuts. The U.S. is now expected to cut in September. The market is telling us that we're going to get a cut in September, and we're going to get a 50 basis point cut. So the market is saying there's an 80% chance of a 50 basis point cut in September, and that the market is also expecting 2 more rate cuts before the end of the year. So each of those rate cuts being 25 basis points. So if we assume the market's right, we get the 50 in September, we get 2 25 basis point cuts before year end. That's a whole 1% knocked off of the Fed funds rate. Dividend stocks are particularly sensitive to a move in monetary policy, i.e. those stocks tend to do well when the Fed or central bankers around the world are lowering interest rates. Now, you may be thinking to yourself that if the central bankers are lowering interest rates, then we may be at risk of a recession. And you would be correct in that assumption. There is generally that risk out there, and that is worrying the markets. And it's one of the reasons why we're seeing this elevated level of volatility. And as a general rule of thumb, if the economy were to fall into a recession, the other benefit of those dividend stocks is they tend to be a bit more defensive in nature and can prove beneficial in that type of market. So think of a company that makes $100 and they need 50 of those $100 to pay the dividend, to finance that dividend. The beauty, that's the 50% payout ratio. So they're using half of their income to pay and finance that distribution. And the beauty of the 50% payout ratio is it protects those companies that might hit a loss of a contract. They might hit a slowdown in business. We might hit a recession. If you have that much of a buffer, it tends to protect the market cap of the business. So it's been our philosophy to be more conservative on that side, to have companies on average in the portfolio have roughly about a 50% payout ratio. And the other benefit of that is that means that half of their cash flow can be used for other growth levers in the business. The question I get a lot is, how should my portfolio be positioned? Fast dividend growers tend to outperform slow dividend growers, especially if the Fed and the Bank of Canada employ a slow rate cut cycle, meaning that they're cutting rates, but they're doing it slowly over the next year, as opposed to the Fed and the Bank of Canada saying that we need to cut rates really quickly right away because the economy is in danger of a recession. For us right now, we think it's going to be more the slow and steady rate cut, more of a disciplined rate cut by the central banks. That is how the portfolio is positioned right now. If you have any questions you'd like us to answer, please reach out to your NCM regional sales rep at sales@ncminvestments.com.
Dear financial advisors, you were made for times like these. The times when nothing seems right, and the ones when anything seems possible. Your advice turns potential into reality. It makes dreams come true. And through it all, there's one investment company that's made for you.